Cameron and Tyler Winklevoss are two twin brothers who attended Harvard in the late 2000s. At Harvard, they developed a social media website called Harvard Connection. One of their classmates was Mark Zuckerberg, who allegedly stole their idea to create Facebook. Facebook became a huge success, while Harvard Connection was a failure. The Winklevoss twins sued Facebook, accusing Zuckerberg of stealing their idea. In 2008, Facebook agreed to pay a $65 million settlement to the Winklevoss twins. Having failed to make a successful social media company, the Winklevoss twins looked for the next big thing, and they thought they found it in Bitcoin. In 2015, they used their Facebook settlement money as startup capital to launch a crypto exchange called Gemini. In the early 2020s, Gemini launched an earn product, which offered its customers up to 9% APY on their stablecoin holdings. Gemini generated this yield by lending their customer assets to a company called Genesis. Genesis lent the money to a crypto hedge fund called Alameda Research, which was affiliated with the crypto exchange FTX. FTX and Alameda collapsed in late 2022. Alameda defaulted on its loans from Genesis. Genesis in turn defaulted on its loans to Gemini. At the time, Gemini's customers had deposited $1.1 billion into the Gemini Earn program. After Genesis defaulted, Gemini froze withdrawals. At the time, it looked like Gemini would join the long list of failed crypto companies, but Gemini was able to narrowly avoid disaster. They were eventually able to recoup $1 billion from Genesis's bankruptcy estate. Gemini put up $100 million of its own money and made its customers whole for the full $1.1 billion of deposits. Having resolved the Gemini Earn fiasco, the company continued to operate its crypto exchange. After 10 years of being a private company, Gemini conducted an IPO in September of 2025. So for the first time ever, we get to see their financial statements. The numbers don't look good. Gemini's numbers are some of the most disastrous I've seen from any public company. In the first 2 months of trading, Gemini stock has already lost 2/3 of its value. In this video, we'll take a deep dive into Gemini's business model and financial results. By the end of this video, you'll understand why this company is likely headed towards bankruptcy. While Gemini is likely headed towards bankruptcy, there are many other great companies listed on the stock market. To understand if a given stock is a good investment, you need to analyze their fundamental numbers. Fortunately, this has never been easier thanks to today's sponsor, Moomoo. Moomoo is a one-stop trading platform trusted by over 26 million users across the US and globally. They offer zero commissions on stocks, ETFs, and options trades, free level 2 data, and real-time option chain data. For example, let's look at Netflix. If we scroll to the company tab, we can instantly see tons of useful data. We can see that most Wall Street analysts have buy ratings on the stock. The price to earnings ratio of 43 is pretty high, but it's been a lot higher in the past. We can see that Netflix's subscriber count has been increasing over the past year. We can see their revenue broken down by geography. We can see analysts' estimates for revenue growth. Wall Street expects Netflix's revenue to continue growing over the next 2 quarters, but growth is expected to decelerate. Using Moomoo is such a time saver because you can do so much research all within the app. Currently, Moomoo is running an amazing new user promotion. They offer a 3.6% yield on your idle cash, but for the first 3 months they offer an additional 4.5%, bringing your total yield up to 8.1%. Additionally, if you open a new account and deposit $100, they'll give you a $20 fractional share of Nvidia for free. The more you deposit, the more Nvidia shares they'll give you, up to $1,000. This promotion only lasts until the end of the year, so make sure to sign up today with the link in the description below. And now back to the video. While the crypto exchange is called Gemini, the company's official name is Gemini Space Station. In much of their investor-facing materials, they include either CGI or AI-generated images of astronauts in space. The company has nothing to do with outer space. They just call themselves Gemini Space Station because they think it sounds cool. Gemini has 2 main business segments that we'll be analyzing today. Their core business is a crypto exchange. They have an app and a website where you can trade dozens of different cryptocurrencies. Their second business is crypto credit cards. We'll start off by looking at their crypto exchange business. The Gemini crypto exchange primarily generates revenue by charging transaction fees. Every time you buy or sell a crypto, you have to pay a 1.5% transaction fee. If you place a market order, you also need to pay a so-called convenience fee of 1%, so you might pay as much as 2.5% every time you buy or sell crypto. If you're an active trader, the fees add up very fast. For example, if you make just 1 trade per month, you'll pay 30% in transaction fees over the course of a year. The Winklevoss twins and many other crypto bros talk about how crypto is supposedly better and more efficient than the traditional financial system, but Gemini itself disproves this. Today, the vast majority of stock brokerages offer zero commission trading. There's payment for order flow, so you might get a slightly worse execution price, but we're talking about a tiny fraction of a percent for large liquid stocks. Not the 2.5% Gemini charges. In 2024, Gemini made $96 million of transaction revenue, an increase of 71% versus 2023. In the first 9 months of 2025, they generated $71 million of transaction revenue. If we annualize that, they'll probably make $95 million of transaction revenue for the full year of 2025, about the same as they made in 2024. Crypto trading revenue is highly cyclical. When there's a bull market, people get excited about crypto and trade more. When there's a bear market, vice versa. In 2024, the price of Bitcoin and other cryptocurrencies increased substantially. This can largely explain the increase in Gemini's transaction revenue. If we compare a chart of Gemini's monthly active users and the Bitcoin price, we can see that the correlation is very high. Gemini's crypto exchange business is subscale. In the first 9 months of 2025, they had $41 billion of trading volume. For comparison, during that same period, Robinhood had $161 billion of crypto trading volume. That's 4 times more than Gemini. And Robinhood is primarily a stock brokerage. Crypto is a side business for them. Competition in the crypto industry is fierce. There are dozens of crypto exchanges, and most stock brokerages now offer crypto trading as well. This obliges Gemini to spend exorbitantly on marketing, and they still have a pretty low market share. Now let's look at Gemini's consolidated financial results, which are pretty atrocious. In 2023, Gemini generated $98 million of consolidated revenue. This is mostly transaction revenue, plus staking and a little bit of credit card revenue, which we'll talk about later. That year, they generated an operating loss of $312 million for an operating margin of negative 318%. In 2024, revenue increased to $142 million thanks to the crypto bull market. Yet they still managed to lose $166 million for an operating margin of negative 117%. In the first 9 months of 2023, they generated $119 million of revenue and an operating loss of $234 million for an operating margin of negative 196%. To be fair, in 2023, they had $98 million of legal costs related to the Gemini Earn debacle. In 2024, they had another $12 million of legal expenses, also related to the Gemini Earn debacle. In 2025, they had $49 million of stock-based compensation related to their IPO. If we exclude these extraordinary charges, things look a bit better, but not much. In all 3 years, their operating losses were more than 100% of their revenue. Keep in mind, Gemini is not some new startup. They were founded 10 years ago in 2015. And even during the crypto bull market of 2024, they still managed to lose more money than they made. So why do they lose so much money? Part of it is because they need to spend so much money on advertising to acquire customers. Given the competitive nature of the industry, this is something all crypto exchanges have to do. But this doesn't explain everything. Gemini's losses are especially atrocious. It is a very poorly run company. Gemini has a line item called transaction losses. In 2023, they incurred $28 million of transaction losses, which represented 28% of their revenue. In 2024, they had $20 million of transaction losses, representing 14% of revenue. In the first 9 months of 2025, they had $15 million of transaction losses, representing 13% of revenue. 2025 is a bit complicated because the losses come from both their crypto exchange and their credit card business, which we'll talk about later. Gemini's credit card business only became significant in 2025. In 2023 and 2024, almost all of these transaction losses came from the crypto exchange. So what are these transaction losses? When you open a new Gemini account, you need to fund your account to begin trading. You typically do this by initiating an ACH transfer from your bank. The ACH transfer takes a few days to arrive at Gemini. In the meantime, they give you instant deposits. So say you initiate a deposit for $5,000. Gemini gives you a loan of $5,000 so you can start trading immediately. 3 business days later, when the deposit arrives, the loan is repaid. Sometimes the ACH transfer never arrives. Maybe there wasn't enough money in the account, or the bank flagged the transaction as fraudulent. If the ACH transfer never arrives, Gemini will liquidate your account to try to recoup that money. But let's say you use the instant deposits to buy some altcoin, which tanks in value during that 3-day period. Gemini eats that loss. The amount of money Gemini loses from these failed ACH deposits is absurd. These losses represented 28% of their revenue in 2023. It got a little better in 2024, but it was still 14% of revenue. In my opinion, the only way to explain these massive losses is fraud. Gemini is probably being exploited by fraudsters, who have found some way to trick Gemini into thinking they initiated an ACH transfer and used the instant deposits to buy some altcoins they're trying to pump. It's again important to stress that the Gemini crypto exchange is now 10 years old. and they still can't even figure out how to protect themselves from fake ACH deposits. Cameron and Tyler Winklevoss aren't very good at running a crypto exchange, and I don't expect this to change anytime soon. Gemini claims that its mission is to bridge the worlds of traditional finance and crypto. The main way they're trying to do this is with their crypto credit card. Since 2021, Gemini has issued credit cards. Many credit cards offer cash back on your purchases, but instead of paying cash, the Gemini crypto card pays you crypto, which is deposited into your Gemini trading account. You can decide which cryptocurrency you want to receive as your credit card rewards. Currently, they give you 4% crypto back for spending at gas stations and EV charging, 3% on dining, 2% on groceries, and 1% on everything else. Gemini doesn't have the expertise or licenses to issue credit card loans on its own, so they partner with a wholesale bank called WebBank. While the credit cards are branded as Gemini, they are actually issued by WebBank. The credit card loans are originated by WebBank. Here's how it works. A customer applies for a Gemini credit card. The application is processed by WebBank. WebBank decides whether or not to approve the customer. When the customer borrows money on the credit card, the loan originally comes from WebBank. The loans are called credit card receivables. Gemini is obligated to purchase all the receivables from WebBank. WebBank sells the receivables to Gemini at a slight premium. That's how WebBank makes money. Gemini needs to purchase all of these receivables. So where does Gemini get the money to do this? They borrow the money from another crypto company called Ripple Labs. Gemini has a revolving credit facility where they can borrow money from Ripple at a 6.5% interest rate. Once Gemini purchases the credit card receivables, they have two sources of revenue. Every time you pay for something with your credit card, the merchant pays a fee of approximately 3%. This fee is called interchange. Some of it goes to MasterCard, some of it goes to the merchant acquirer. That's the company that operates the point of sale terminal. But the majority of the fee, about 2%, goes to the issuer. In this case, Gemini. So Gemini receives revenue equal to approximately 2% of transaction volume. If you carry a balance on your Gemini credit card, you pay an interest rate of 17 to 29% APR, depending on your credit score. Remember that Gemini purchases the receivables from WebBank at a premium. The interest revenue they receive is slightly less than what the customer pays, because some of it went to WebBank. The main cost Gemini incurs related to the credit card is the crypto rewards, which range from 1 to 4% of transaction volume. They are also on the hook for when credit card holders default. All the crypto bros, including the Winklevoss twins, love to talk about how crypto is so much better than the traditional financial system, and will make everybody's lives so much better. In the case of Gemini specifically, they say it will bridge the gap between traditional finance and crypto, thus getting the best of both worlds. In reality, their so-called crypto credit card is just a normal credit card. It's issued by a traditional bank and operates like pretty much every other credit card. The only difference is the cash back they pay you is denominated in crypto. This is not some great innovation. It's just a marketing gimmick. Gemini released its credit card in 2021, but at first they didn't start marketing it very much. In the summer of 2025, they launched a massive marketing campaign across the United States. The credit card only became a significant contributor to their consolidated financial results in the third quarter of 2025. They timed the big marketing push to coincide with their IPO. The new credit card business was a growth narrative they tried to sell to investors. In the third quarter of 2025, Gemini generated $8.5 million of revenue from its credit card business. This was only 17% of their consolidated revenue, but it increased 226% versus the year-ago period. While still a minority of revenue, it represents the fastest growing piece of the company. While credit card revenue is growing quickly, the economics are atrocious. In the third quarter, they generated $8.5 million of credit card revenue. Gemini doesn't disclose what portion of this is from interchange and what portion is from interest income, but we can make some estimates. They disclosed that their credit card customers had $350 million of aggregate transaction volume during the quarter. They previously disclosed that they generate interchange revenue of approximately 2% of transaction volume. That means they generated about $7 million of transaction volume in the quarter. Total credit card revenue was $8.5 million, so they only generated $1.5 million of interest income. The vast majority of their revenue comes from interchange. They make almost no interest income. Their single largest cost associated with operating the credit card is the crypto rewards they pay to customers. They don't disclose how much they spend on crypto rewards. It's included within the sales and marketing line item. But they did say that crypto rewards increased by $10.8 million versus the year-ago quarter. So Gemini paid out more in crypto rewards than they generated in credit card revenue. They also incurred $2.8 million of credit losses. This is from customer defaults. Finally, they paid $314,000 of interest expense to Ripple. Remember, they borrow money from Ripple to fund the credit card loans. During the quarter, Gemini's credit card business incurred a contribution loss of $5.4 million. This does not include any allocation of corporate overhead. It also does not include advertising expenses. They spent tens of millions of advertising dollars to acquire their credit card customers in the first place. Once they acquire a customer, they lose even more money. To understand just how bad Gemini's credit card business is, let's compare them to Synchrony Financial, which is a traditional credit card company. Synchrony Financial is far bigger than Gemini. In the third quarter, they generated $6 billion of total revenue. The vast majority of their revenue, 95%, came from interest income. Only 5% came from interchange. Synchrony offers cash back to its customers. Their main credit card offers 2% cash back on all purchases. In the third quarter, Synchrony paid $368 million of cash back to its customers. This is slightly greater than the $272 million of interchange revenue they generated. If you pay off your full credit card balance every month, the credit card issuer almost certainly loses money on you. The cash back or points they give you is greater than the interchange revenue they generate. All of the credit card industry's profits come from people who fail to pay their full balance at the end of the month. They pay an interest rate of 20 or even 30% on their outstanding balance. This is far more lucrative than the 2% interchange fees. Of course, some of these people default. In the third quarter, Synchrony suffered $1.1 billion of defaults, but this was only 19% of their revenue. The massive interest income they generated was more than enough to cover the defaults in their own interest expense, so they generated a contribution profit of $3.5 billion, almost 60% of revenue. Traditional credit card companies are extremely profitable, but Gemini is extremely unprofitable. The main reason Gemini is losing so much money is that they generate minuscule interest income, but they pay massive crypto rewards to their customers, and they incur massive credit losses as well. In the third quarter, they generated $2.8 million of default losses. This is almost double their interest income. So how is it the case that Gemini suffers such massive credit losses compared to their paltry interest income? Remember that Gemini does not issue the credit cards directly. They have neither the expertise nor the licenses to do so they have to use WebBank as a middleman. The exact details of their contract with WebBank are not disclosed, but based on the little information we do have, the relationship seems to be very skewed in WebBank's favor. Gemini has an outstanding commitment to purchase all the credit card receivables offered for sale by WebBank. Gemini is required to purchase receivables even if they are fraudulent or in default. I think this can explain the massive disconnect between Gemini's paltry interest income and massive default losses. WebBank originates the credit card loans. At first, they hold them on their own balance sheet and collect the interest income. It sounds like WebBank has discretion to decide when they sell the receivables to Gemini. Whenever they do decide to sell them, Gemini is obligated to purchase. As soon as they identify an account as fraudulent or in default, they sell that loan to Gemini. Gemini eats all the losses while WebBank takes much of the interest income. We don't know the exact details of the WebBank arrangement, but based on Gemini's atrocious financial results, it is almost certainly skewed massively in WebBank's favor. In Gemini's shareholder letter, they brag about how much their credit card business is growing, but you have to dig a lot deeper to calculate its profitability. If you look at Gemini's income statement, the line items are very vague. Credit card default losses are subsumed within the transaction losses line item. This also includes the losses they incur from fraudulent ACH deposits to their crypto exchange. The crypto rewards are subsumed within the sales and marketing line item. We had to read between the lines and make a lot of assumptions to estimate how much they're losing in their credit card segment. In my opinion, Gemini intentionally gives only vague disclosures to make it less obvious that their credit card business is a money sink. Going into the IPO, the Winklevoss twins hyped up how fast the credit card business is growing. Shortly after the IPO, they reported Q3 earnings, which showed a massive operating loss of $121 million. Investors quickly caught on to how terrible the business is. Gemini has only been publicly traded for less than 3 months. Their stock price has already declined by more than 2/3. Unless they can somehow renegotiate their relationship with WebBank, I don't see how their credit card business will ever be viable. And their crypto exchange, which is now 10 years old, is still losing money. The outlook for Gemini Space Station is very bleak indeed. Alright guys, that wraps it up for this video. What do you think about Gemini? Let us know in the comments section below. As always, thank you so much for watching and we'll see you in the next one. Wall Street Millennial, signing out.